Hello friends, today we are going to start a new chapter, that is chapter 9, financial management. So when we are talking about financial management, as we know that to run a business we need for to do every kind of activity or to carry out every kind of activity, we need some money, we need some finance. So let's try to understand what is meaning of business finance first. Business finance means money required for carrying out business activities is called business finance. So now onwards we can try to understand what is meaning of financial management. So financial management is concerned with optimal procurement as well as usage of finance. So two things are there, procurement and usage. So we have to manage both of the things, that is including in financial management. So as the management word is there, let's try to understand another definition. Financial management deals with the planning, organizing, directing, controlling financial activities or like procurement, utilization and funds of an enterprise. So you can see that the same things are that, but here you can see management functions are also part of financial management. So when you analyze both of the definition, you will come to know that financial management is related with optimal procurement of finance, it is related with optimal usage of finance, and it is also ensuring availability of finance throughout the year whenever it is required. It is a responsibility of financial management that they should provide the money. Next is decision related to investment, financing and dividend is also a part of financial management. Alright, let's try to understand its role and management, its role and importance of financial management. So when we are talking about financial management is related with the financial health of an enterprise. In fact, we are talking about all the items appearing in financial statement like balance sheet and profit and loss account. All are influenced by the some of the decision taken by financial management. As we know that balance sheet is showing our financial position, profit and loss account is showing our financial health, but they all are affected by the decision by the financial management. In other words, we can say that all the financial activities of an enterprise is directly or indirectly influenced by the financial management. Alright, so let's try to understand its importance with the help of these points. First is size of composition of fixed assets of the business. So when we are talking about size of fixed asset, it is directly depending on the investment decision or capital budgeting decision. So how much company is planning to invest in the fixed asset, they will decide in capital budgeting. And if they are deciding that 20 crore we want to invest in plant and machinery, they will raise the amount to invest in a fixed asset of 20 crore rupees. So like that way we can say that it is a decision of financial management that how much size they want to keep in form of fixed asset. Why? Because fixed asset what happened, the money will be blocked for the long period of time. So financial management is deciding that how much money we want to block in terms of in fixed assets, we can say. Next is the quantum of current assets and breakup into cash, inventory and receivable. So this amount of investment in current asset and its division is also depending upon financial decision. What is their credit policy, what is their inventory management, what is the nature of business. All these things are affecting the total current assets and their composition. Next is the amount of long term and short term fund to be used. So financial management is deciding that about the long term and short term financing requirements of business, and it is assumed that short term finance is cheaper than long term finance. Thus cheap financing would be increase the profitability of the business. So we can say if the firm which want more liquidation, they will require more long term finance. So what happened, their profit will be decreased. Why? Because they have to pay more interest on long term debt, because as compared to short term debt we have to pay more interest on long term debts. Okay, next is a breakup of long term financing into debt and equity. So financial management determines the proportion of funds raised by the way of long-term debt or equity capital. So such decision is also called financing decision. So they are deciding here. All right, so in equity which things are there? Equity share capital is there, preference share capital is there, in debt bank loan is there, debenture is there. So they are deciding, the financial management will decide what will the proportion of both of the capital. Next is all items in the profit and loss account, that is interest expense, depreciation expense, etc. So what will happen here? Various items are there in profit and loss account of a company. They are also affected by the financial management decision. For example, if the higher amount of debt means they have to pay higher rate of interest in future. So similarly, repair of machinery is likely to be decreased. The profit of the year, like that way these amounts are increasing or decreasing the profit. So these all items are also affected by the decision of financial management. All right, so all things are related with financial management. So you can easily remember all this point with the help of this one word, that is called FACL. F means fixed asset, size and composition of fixed asset. E means that is a breakup of long-term financing into debt equity. C means the quantum of current asset and its breakup. A is related with all the item of profit and loss account, and L is related with amount of long-term and short-term fund to be used. I hope you understand, friends. Thank you very much.